Have you ever heard the saying, borrowing a chicken to lay eggs? It may sound unusual at first, but the meaning runs deep. Instead of trying to own everything yourself, sometimes all it takes is knowing how to make the most of the right resources, even if borrowed, even if small. With the right approach, those resources can consistently create value, just like a hen laying eggs day after day. This is the core philosophy of the Japanese book Borrowing a Chicken to Lay Eggs by Futoshi Fujikawa. He explains that to grow your wealth, you don't need luck and you don't need rare, once-in-a-lifetime opportunities. What you really need is the right tool, a simple method, and the patience to stick with it over time. And the best part? This principle doesn't only work in Japan, it can be applied to any market, whether in the US, Europe, or globally. If you want to learn how to make your money work smarter for you, instead of staying stuck in the endless cycle of earning, spending, and running out, then Borrowing a Chicken to Lay Eggs is a book you simply shouldn't miss. Before we dive in, if you find lessons like this valuable, make sure to hit like and subscribe so together we can pick up one more egg each day on the journey to financial freedom. Part 1. Don't let hidden fees eat away at your wealth. Futoshi Fujikawa begins with a very Japanese idea. Money is like a chicken. If you take good care of it, it will lay eggs every day. But if you're careless and let others take the eggs, then no matter how many chickens you raise, you'll never truly become wealthy. In investing, the egg thieves he refers to are hidden fees. These could be fund management fees, transaction fees, or even small differences in bank interest rates. The problem is they rarely announce themselves. You don't feel their impact right away, but year after year, they quietly eat away at your wealth. Imagine a familiar scenario for Americans. You put $10,000 into a mutual fund that earns an average of 7% per year. Sounds good, right? But if the management fee is 2% annually, after 30 years, you'll end up with only about $57,000. Meanwhile, if you had invested the same $10,000 in an S&P 500 ETF with just a 0.1% fee, you could have more than $74,000. That's nearly a $20,000 difference, all from what looks like a tiny percentage. The same lesson applies in crypto. Many investors are excited about frequent trading on exchanges that charge 0.2 to 0.5% per trade. That seems small, but if you trade 100 times a year, moving $10,000 each time, you've lost $2,000 to $5,000 just in fees. And that's not even counting slippage or withdrawal costs. In the end, even if the market goes up, your profits are cut down significantly. Compare that to someone who simply bought Bitcoin or Ethereum and held it for years, you'll see how easy it is to raise chickens but lose the eggs. This is exactly the spirit of borrowing a chicken to lay eggs. You don't need a rare chicken to get rich. All you need is the right tool, low cost, efficient, and let it produce eggs steadily over time. But if you choose wrong and let hidden fees eat away at your returns, it's like walking into the chicken coop each morning and finding an egg missing with no idea who took it. Fujikawa's core message is clear. Keeping the chicken is important, but keeping the eggs is even more important. In finance, that means minimizing hidden fees and maximizing investment efficiency. Part 2. Less but better. Choose the right tools, not too many. According to Fujikawa, one of the biggest mistakes people make when trying to build wealth is believing that the more tools they have, the more successful they'll be. He compares it to someone raising a whole flock of chickens without knowing which ones are healthy enough to lay eggs consistently. The result? Endless work, constant confusion, and no eggs to show for it. Futoshi emphasizes that financial tools are not trophies to collect. They're meant to provide steady, long-term leverage. You don't need 10 hammers to drive in a single nail. You just need one good hammer and to know how to use it well. This is especially clear in the world of investing. Many American investors open accounts everywhere. Robinhood, Charles Schwab, Fidelity, then dabble in penny stocks, options trading, and the latest crypto coins they read about on Reddit. They think the more diverse, the better. But in reality, the more scattered their investments are, the less control they have. It's like owning 10 cars but not knowing how to drive any of them properly. The wealthy often take the opposite approach. Less, but better. Take a simple ETF that tracks the S&P 500. It's straightforward, low cost, easy to understand, yet delivers outstanding long-term results. Warren Buffett himself once said, "If you don't have time to research, just invest in an S&P 500 ETF and hold it patiently." That's the smartest choice for most people. One tool, but its value often outperforms dozens of flashy alternatives. Crypto tells the same story. During the meme coin craze, millions of retail investors rushed into obscure tokens, chasing dreams of X100 or X1000 gains. But the truth? About 95% of those projects vanished, swallowed up by whales. Meanwhile, those who focused on Bitcoin or Ethereum, the two most transparent, foundational, and useful projects, still hold significant value today, and many have multiplied their wealth over time. Once again, less but better proves to be the sustainable strategy. Fujikawa doesn't dismiss diversification, but he stresses that diversification isn't about grabbing as much as possible, it's about purposeful selection. With just 2 or 3 right tools, you can build a solid financial foundation instead of spreading yourself thin and losing control. The core message of this chapter: successful investing doesn't come from how many tools you own, but from patiently sticking with a few truly effective ones. Just like borrowing one strong, healthy chicken rather than a whole flock of weak ones, you'll end up with steady eggs year after year.
Part 3. Borrowing a chicken to lay eggs, using small resources to create income. Futoshi Fujikawa offers a financial philosophy that is both simple and profound. You don't need to own everything to create value. What matters is knowing how to leverage the resources available to you, even if borrowed, even if small, and turn them into a stream of recurring income. He calls this idea borrowing a chicken to lay eggs. In today's world, many Americans believe they need massive capital or large amounts of assets to build wealth. But the truth is different. Small steps, combined with the right tools, can create powerful leverage over time. Take real estate, for example. Very few people buy homes entirely with cash. Instead, they use mortgages, a form of borrowing a chicken from the bank. You don't need the full purchase price up front. By using a loan as leverage, you can rent out the property so that rental income gradually pays off the debt while you still build long-term profits. This is a clear example of borrowing a chicken to lay eggs, using borrowed resources to generate sustainable cash flow. The same principle applies in business. Many Silicon Valley startups didn't begin with huge amounts of capital. They borrowed servers or used cloud services like AWS instead of building their own infrastructure. They borrowed funding from angel investors in exchange for time to develop products. By borrowing these resources, they were able to experiment, improve, and scale quickly. If they had insisted on building everything from scratch, most would never have gotten off the ground. Even in personal investing, the lesson holds true. Americans are familiar with margin loans, borrowing money to buy stocks, but without discipline, this becomes a double-edged sword. Fujikawa emphasizes, borrowing a chicken to lay eggs does not mean taking on reckless debt. Borrowing should only be done to create sustainable cash flow, not to gamble. Rental real estate can be the right chicken to borrow, while taking out loans to chase meme stocks is just borrowing a sick chicken. Crypto provides a fresh example. Instead of chasing shady projects, many small investors have chosen to borrow existing blockchain technology to build digital products, NFTs for independent artists, or smart contracts for cross-border payments. They don't need huge capital. They simply use an existing platform, and from there, the eggs, steady income streams, begin to appear. The core takeaway is this: rethink what capital really means. You don't have to own everything yourself. You just need to wisely use what's in your hands, or borrow smartly, to turn resources into a machine that generates recurring income. Fujikawa's message is clear. Don't wait until you have massive capital to get started. Borrow one healthy chicken today, and you'll have the eggs to sustain yourself tomorrow. Part 4. Taxes and incentives, the overlooked legal leverage. One of the key ideas Fujikawa highlights in Borrowing a Chicken to Lay Eggs is this: building wealth isn't just about making more money, it's also about keeping as much as possible from what you already earned. And to do that, taxes become a kind of hidden playing field that only those who truly understand can take advantage of. Americans often say, nothing is certain except death and taxes. But there's a huge difference between tax evasion, illegal, and tax optimization, legal. Fujikawa calls taxes the overlooked legal leverage because most people are so busy earning money that they overlook dozens, even hundreds of opportunities to legally save it. Take a familiar example. The average American employee earns a salary, pays full income tax, and spends what's left. Meanwhile, a small business owner or real estate investor can deduct home office expenses, mortgage interest, depreciation, and even education costs. Their way of borrowing a chicken is by using the tax system itself, turning necessary expenses into legal deductions, reducing tax obligations, and keeping more cash in hand. In real estate, Warren Buffett once pointed out that savvy investors don't just look at rental income, but also at the tax benefits. For example, depreciation allows you to show a paper loss while still enjoying positive cash flow. That means the eggs from your borrowed chicken can be far more plentiful than they appear. Even in stock investing, many people overlook tools like the 401k, Roth IRA, or HSA, special hens gifted by the US government that let you defer or avoid taxes for decades. If the average American simply leaves money in a regular savings account, after 30 years, much of it will be eaten by taxes and inflation. But if that same money is placed into a 401k, the compounding effect and tax benefits can turn it into a massive golden egg. Fujikawa warns, don't think taxes are only for the wealthy to worry about. In reality, anyone can use legal incentives. The real question is, are you willing to learn, understand, and design your finances intelligently? The same applies in crypto. When the hype exploded, millions of Americans rushed to trade coins without paying attention to capital gains taxes. The result? Some made big profits, only to see them wiped out by a tax bill at year's end. Meanwhile, professional investors took the opposite approach, holding long-term or moving assets into tax-advantaged jurisdictions, turning fragile profits into sustainable wealth. Fujikawa's core message is simple: the money you keep is the money that's real. If you don't take advantage of legal tax strategies, you're letting your wealth bleed away day by day. And sometimes, just a bit of tax knowledge can make a bigger difference than a decade of hard work. In other words, don't just focus on laying more eggs, learn how to keep them from falling out of the basket on the way home.
Part 5. The Power of Simplicity and Patience. Futoshi Fujikawa emphasizes that wealth is not a game reserved for the smartest people. It is a reward for those who are patient and know how to keep things simple. In Borrowing a Chicken to Lay Eggs, he warns about the temptation of complexity. People are often drawn to sophisticated financial strategies, complicated derivatives, or flashy new coins promoted with hype. But the more complex things become, the higher the risks and the greater the chance of costly mistakes. Think about Warren Buffett. For decades, he has stayed committed to a remarkably simple philosophy: buy businesses with real value, hold them for the long term, and let time do the rest. If Buffett had spent his career chasing hot stocks or diving headfirst into bubbles like the dot-com craze or the crypto hype, he likely wouldn't have become one of the greatest investors in history. Here's a more relatable example for many Americans. Countless people dive into day trading, hoping to double their money in just a few months. They stay up late glued to charts, obsess over candlestick patterns, and trade non-stop, only to end up exhausted with little to show for it. Meanwhile, an ordinary person who simply invests consistently in an S&P 500 ETF and holds it patiently for 20 to 30 years will almost certainly outperform most of those short-term traders. Simplicity and patience wins. The same lesson holds in crypto. Among thousands of tokens that appear and disappear, investors who chose to simply buy and hold Bitcoin or Ethereum for the long term have survived and often thrived
far more than those who constantly rotated into risky altcoins. As Fujikawa would put it, borrowing one healthy chicken and letting it lay eggs for many years beats chasing after a noisy flock that disappears overnight. The core point Fujikawa drives home is this: simplicity helps you stay the course, and patience multiplies your results. When you keep things simple, you reduce mistakes, lower costs, and make it easier to stick with your plan. When you stay patient, you give compounding and cash flow the time they need to unleash their full power. He compares wealth to planting a tree. You don't need to keep pulling it out of the ground to check if the roots have grown. You just need to plant it in the right spot, water it regularly, and let time do its work. That is the art of sustainable investing. Simplicity plus patience, leading to real growth in your assets. The key message: don't get swept away by complexity or the promises of getting rich quick. Keep things simple, stay steady, and let time become your most loyal ally. Part 6. Investing is not a short-term game, but a lifelong habit. In Borrowing a Chicken to Lay Eggs, Futoshi Fujikawa makes it clear: investing is not a gamble you play once and walk away from, it is a lifelong journey. Those who treat it like a short-term game usually end up paying the price in both money and time. Fujikawa compares investing to taking care of your health. You can't hit the gym for 30 days straight and expect to stay fit for life. Good health requires repeated habits: eating well, exercising consistently, and getting enough rest. Investing is no different. It's not about one lucky trade or jumping on a hype cycle. It's about saving, investing, and staying disciplined over decades. The history is clear. In the US, millions poured money into bubbles like the dot-com boom in 2000, the housing market in 2008, or the crypto frenzy of 2021. Many joined late, chasing quick profits, only to lose everything. Meanwhile, those who stayed loyal to their 401k, IRA, or simply invested in ETFs month after month for 20 to 30 years built wealth that was far more stable and lasting. Fujikawa stresses an essential truth: investing is a behavior, not just a strategy. You can memorize every financial formula or valuation model, but unless you turn it into a habit, such as setting aside part of your income every month or automating your savings, you'll likely fail in the long run. Take this example. Imagine a young American earning $60,000 a year. If he invests just $500 a month into the S&P 500 for 30 years at an average annual return of 8%, he could build nearly $750,000, enough to retire with freedom and peace of mind. The magic is not in finding a rare chicken, but in letting an ordinary one lay eggs steadily year after year. The closing message Fujikawa leaves us with is this: wealth doesn't come from a single move, but from thousands of small steps repeated over time. Treat investing like breathing: consistent, steady, and lifelong. In the end, Futoshi Fujikawa reminds us that wealth doesn't come from luck. It comes from mindset and small habits sustained over a lifetime. You don't need to own everything. You just need to know how to leverage the right resources and stay patient while your chicken keeps laying eggs. If you want to build lasting financial habits, start with small steps and make learning a part of your daily life. A simple suggestion? Listen to an audiobook for 30 minutes each day on this channel, and each day you'll move closer to financial freedom. If you found this video valuable, don't forget to hit like and subscribe so we can continue this journey together, exploring investing, financial thinking, and the path to true freedom.